Hello and welcome to FP Live. I'm Ravi Agrawal, Foreign Policy's Editor-in-Chief. Is the AI boom a bubble? All of a sudden, it is the question on everyone's mind, and it's a particularly urgent question as data shows that growth in the AI sector might be masking real weaknesses in the rest of the economy. In a moment, I will speak with a top economist who's been raising the alarm about AI. As always, we will take some subscriber questions. If you would like to join in, there's a healthy discount going right now, so take advantage of that. And we are also a podcast. Just look for FP Live on your favorite audio platform. So let's bring our guest right in. Jared Bernstein was the chair of the Council of Economic Advisors under President Joe Biden. He is now a senior fellow at the Center for American Progress. He recently wrote a New York Times op-ed making the case that we are now in an AI bubble. Jared, welcome to FP Live. So let me just start with a simple question. How do you define a bubble?
Yeah, a bubble occurs when the level of investment in an asset is so high that investors stop believing they can get an adequate return on that investment in a reasonable time frame. So they pull out, and the highly elevated valuations start to deflate. And that's a bubble and how a bubble can burst.
So, by that definition, we've had two bubbles this century, the dot-com bust in 2001 and then the housing crisis in 2008. Tell us why you think AI might become the third one.
Well, first of all, thank you for saying might, because one has to hedge such predictions. What Ryan Cummings and I argued in a recent New York Times op-ed piece was that AI certainly has a lot of bubbly characteristics in the spirit of the definition I just gave you. And the evidence therein, to answer your question, is obviously the valuation of the firms involved, often referred to as the Mag 7, is north of 20 trillion with a T. So very high, very quick valuations. Probably more to the point, the price to earnings ratio, meaning how valued the price of these companies, those valuations relative to their earnings, is quite bubbly and quite excessive. So that's often a sign. A concrete example, because this stuff can get pretty abstract pretty quickly, is that OpenAI, one of the premier AI firms in the Mag 7, said that they're going to invest $1 trillion this year, and their revenue is something like 13 billion. Invest a trillion, very low revenues. Now, obviously, that's 1 year. And one of the key points we make is that these returns are expected over many years. So if investors have the patience to wait it out, then perhaps the bubble will disinflate without causing much damage. But with the internet bubble, precisely what we're describing, you had very high price earnings ratios by some measures, higher than they are now, but not that much higher. And investors got, quite impatient. You started seeing some bankruptcies among the firms. The bubble deflated, and we had a recession.
Hmm. And I just want to sort of call out a couple of other things that lead people to call this current moment a bubble. One example that often comes up is Mira Murati, formerly of OpenAI. Her new startup, Thinking Machines, it was valued at $10 billion without really offering a product or a plan. And she was able to raise $2 billion immediately off of that. There's also growing concerns that there is a lot of financial opacity, quirky accounting practices sometimes around some of these investments you're describing. And then lastly, the thing that scares off people is also this idea of circular investments. So
Mm,
a lot of these AI companies investing in other AI companies, which are investing in other AI companies. For example, NVIDIA pledging to invest in OpenAI, but OpenAI will then spend some of that money on
right.
buying more chips. When you look at all of these practices that are making people worry, um, how much of that feels like, particular to AI? How much of it reminds you of the dot-com bubble?
Great question. By the way, that circular financing is really an interesting and potentially problematic development, as you mentioned. I mean, imagine that Safeway lends me money, I go to Safeway and buy groceries. That might look good on our balance sheet for 5 minutes, but obviously, if that circle stays closed, you end up with exactly the problem that I don't want to lose sight of. For all the nuances you just injected, and I will answer your question, it all comes down to revenue generation. Remember, if these companies fail to generate the kinds of revenues that justify their valuations, then the likelihood of a bubble grows and could grow quickly. And the things you raised are precisely the sort of things that would potentially lead to that problem. Circular financing, such that you don't have enough outside investments flowing in. You mentioned business models. And here I actually think AI is in a stronger place than the internet bubble back in the late 90s, 2000s. I mean, the way I like to think of it is Meta or Alphabet not equal to pets.com.
Right.
Pets.com is kind of the classic example of a company with, a very indefensible business model. But here's the thing. This is a common argument about why AI is not a bubble. The idea that these companies generate a lot of cash flow, unlike some of the fly-by-nights or the one you mentioned in the AI space. Amazon sells gazillions of things to the world, and Meta and even Tesla, Microsoft, they all have cash flow. But here's the thing, then, and it's a calculation that Ryan did. If you actually isolate the cash flow that's generated from AI versus their spending on AI. So take Amazon, all the books and cat food and shirts and sweaters you get from it, take that out of the picture and look exclusively at AI. There you see a very stark imbalance. They're investing around $100 billion a year each, and their revenues are in the single digits, billions. So huge gap there. And so I'm a little bit um,
Mm.
underwhelmed by the argument that says, well, they still have these companies still have a lot of cash flow. They have a business model that goes well beyond the ephemeral ones we were just mentioning. We're talking about the AI component. And if the AI component fails to generate the profitability that is required to meet the valuations, that part will bust. Doesn't mean the companies will go out of business. It means that a lot of investors will lose, we'll have a bubble, and then the economic implications therein.
Mm.
One final point on that is that, remember, I should have said this earlier. I know you know this, our viewers do as well. Just because a technology is a bubble doesn't mean it won't be transformational. Doesn't mean that like the internet, we had a dot-com bubble, no question about it. The unemployment rate went up about 2 percentage points when that bubble burst. A lot of people got hurt. Obviously, the housing bubble was much worse. But in the case of the internet, it's obviously been a highly productive and transformational investment.
So I want to start using some of the arguments that people use when they try to push back against, for example, the op-ed that you wrote in the New York Times. And you were inching towards some of it, but part of the thing that gives AI boosters a lot of confidence is the companies in the Magnificent Seven, so Microsoft, Amazon, Facebook, Nvidia. These aren't just any companies. I mean, these are the most profitable companies in the history of the world. They are not playing with borrowed money. So this clearly isn't the housing crisis. Their valuations are high, but they're not that crazy when you recall that the likes of Oracle was trading at 100x its earnings in 1999. So if you look at the fact that these companies just have so much money and they're playing off of their profits to sort of move towards dominance in the future, and that's why they're spending as much as they are right now, and they can afford to do so, that makes it sound less like a bubble.
To some extent, that's true. But let me reiterate the point and put some numbers on it that I made a few minutes ago. And again, these are calculations by my colleague, Ryan Cummings. If you look at AI spend versus AI revenues for Microsoft, Amazon, Google, Meta, you'll find that their AI spend, their CapEx or the capital expenditures plus their R&D spending range from 70 billion to 100 billion in 2025. This is estimated because we're still in the year.
Hmm.
The highest amount of revenues is Microsoft at 15 billion. The lowest is Meta at 300 million. So Meta is a good example. 70 billion of CapEx investment, 300 million of revenue. Now, if AI is a bubble, and it turns out that over the next, you might say, 5 years, depending on investors' patience, that gap doesn't close enough, it doesn't mean that Microsoft, Amazon, Google, Meta, et cetera, will go bankrupt. As you say, these are solid companies with many other lines of business. And of course, Amazon is exhibit A in that regard.